Let's get this let's get this spicy episode, aka epicy. That's where that word came from. Spicy episode started. Showtime, baby. It's showtime. Ladies and gentlemen, welcome to another episode of Rein It In. And today, Patrick, we got 5 sticky notes, but only because there's one sticky note with a lot of different topics on it. We're going to end with rapid fire economics, which I know you're super excited about. We're going to be talking about a ton of market indicators. So that is one sticky note. The other thing we're going to talk about is commercial property. We got some major headwinds perhaps coming down the line. We're going to point those out. We're also going to talk about the unemployment rate as well as the employment rate and why that's so relevant to real estate investors. Then we're going to get into inflation numbers. And finally, we're going to talk about property prices because it's been 1 year since the big drop. This is a big show. Let's get into it.
We're going to crush this episode, JG. Crush it. Before we get started, JG, let's just ask politely. We need subscribers. We need likes. We need comments. We're trying to grow this channel by bringing you amazing value, amazing insights into the real estate world. So make sure that you subscribe. Make sure that you like us. Let's get this done.
All right, ladies and gentlemen, the first sticky note on my desk is we're going to talk about property prices, Patrick, because it's been 1 year. We're now April of 2023. And it was really in April 2022 where people were like, oh my gosh, I think the market has reached its peak. And actually, we actually found out after the fact that the peak was actually in February, but most people didn't know this. But April 2023 compared to April 2022, things are changing in the property prices across the country, by the way, in a variety of different averages, which we're going to show some charts. But this is where we're at right now in the real estate market.
Yeah, we went from the world's coming into an end, in terms of prices dropping. Everybody was freaked out. Interest rates, all of the drama that goes into as we shift into that slump. And guess what? It's actually been pretty short-lived. We're also already starting to see a slight tick up. And we have to look at the numbers and say, okay, are we at the bottom? That's the big question that's being asked: is are we at the bottom?
Now we'll talk about bottoms in a second, Patrick. But I want to just recount. And if I wish I could, magically do a replay right here, where you and I were talking about how we were heading into a slump in September and October of the previous year before, like April 2022. It was really in September, October, November of 2021 that you and I were saying, listen, folks, the indicators are not strong enough to support these kinds of property prices. Be very, very careful. Be aware of what's happening in the marketplace. And then we saw the market turn in February, March, and April of last year. But the point is this stuff is predictable, Patrick, when you look at the real market indicators. And you and I, and it's not just you and I, but the Real Estate Investment Network and our research team saw this coming. We had an event showing real estate investors that we had moved from boom to slump, and we called this across the country, in fact.
We did, and it's something that we'll start to hear is that, we must be going back into recovery. It's still too early to say that we're coming into any cycle of recovery. We're still in slump pretty much right across the country, some different versions of it, depending on what province, what particular city that you're looking at investing in. But that's the thing about it, is that a lot of these are being driven by emotion. A lot of the decisions people are making are being driven by emotion. And let's just get back to some realities around this. We're talking to real estate investors primarily on this particular video. So when you're seeing the headlines, you're listening to and hearing all about home buyers and wannabe home buyers, and I can't buy a home buyer, and first time home buyers, and next time home buyers. It's like all about home buyers. This is not the conversation that we're having. I have lots of compassion and empathy for them, but I'm only looking at this and talking about housing and property from the perspective of what does it mean to us as investors. And we have to keep stressing that because it's easy to get caught up in the headlines, JG.
Yeah, 100%, Patrick. So let's look at this chart here, because as you look at this chart, you can really see how January of 2022 was really the peak. And then in February of 2022, there was another rise, but it was in fact March of 2022 where prices ticked down just a little bit. And then we saw a pretty significant drop month over month over month over month over month up until January of this year. The question you asked a while ago, Patrick, and it's worth debating, is this the bottom or is this a false rally? What are your thoughts?
Well, you know where I'm going to go with this, and I'm going to say it right away. It depends, and it depends regionally and certainly municipally. Is where are you looking at? Because as much as we see these and hear these big drops happening, we know that Toronto and Vancouver are the primary drivers of that, in certain areas of Southern Ontario. So when you look at those big number drops, it affects the overall average of the smaller populated areas, and we can go to Western Canada as in Alberta, Saskatchewan. So it all, if you lump it into one big bucket, the numbers look kind of deceiving. They are deceiving. And have we hit the bottom? Again, I'm going to say this. I think in most markets, I think we have. I think that you might see some specific areas where they're going to come down a little bit further.
I'm going to give people a different perspective, Patrick, which is I think talking about the bottom, and I understand why we like to talk about bottoms. It's all the headlines, it's all the news, it's all the pundits out there that like to call the bottom so that they appear to be right. Trying to call a bottom is really stupid, in my opinion, Patrick, because when it comes to real estate, it's not about timing the market, it's about time in the market. Whether you try to get in at the perfect bottom or not, and I've been saying this since actually the fall of last year, 2022, where I said most of the drop has happened, which is if you're a real estate investor, you should definitely be looking to get back in. Are you going to time the market perfectly? Are you going to get the exact bottom? No, probably not, because that's very difficult. And in fact, it's probably almost impossible. It shouldn't even be an objective for people to catch the bottom. What is important is that those deals that showed up in October, in November, in December, in January, in February, in March, if those are good deals, whether it's at the bottom or not really doesn't matter. A good deal is a good deal. The numbers are the numbers. And as a real estate investor, we're not trying to catch the bottom. We're trying to get a return on investment. And so I'm not a big fan of trying to catch the bottom, Patrick. And I think the bulk of it has happened. I think it actually happened in fall of 2022.
That's a really good point, by the way, Gigi. We have to look at the wording and the language that we use of saying the bottom. I'm looking at it, when I'm talking about the bottom, if I'm investing in a market and I'm looking at a piece of property, I'm doing the math, and does the math make sense, yes or no? The question I'm asking myself, do I see further downside of this particular area? And that's one question I might ask myself, but I'm investing, depending on the strategy, I'm assuming that I'm going to invest in a buy and hold, and that I'm not, trying to flip that property for appreciation in a year or two. Yes, I'm looking, is there more downside? Do I want to wait because I think there's going to be more downsides because I want to pick that up at the end of the game? But ultimately, that's a good point. We're not looking for the bottom. We're actually looking and saying, what is it going to return in the future, depending on the strategy I'm using?
Now, a couple other things I want to point out here, Patrick. You're looking at this chart here where the MLS home price index, and this particular chart shows year over year percentage change. And this is the kind of chart the media loves to use, this kind of chart, because it shows a huge decline. And the reason it does that, Patrick, and we really got to break down this chart, because if you take this chart and if you understand it logically, you're going to see that in the next month and 2 months and 3 months and 4 months, this chart is about to reverse and going to start going back up. And the reason for that is because when you look at year over year percentage changes, they're often, first of all, very misleading. They're very, very challenging to understand. And that's because you're looking at a couple numbers. You're looking at the base effect of what the number's being compared to, and you're looking at the current market today. And when you look at a chart like this, it looks super scary. And these kinds of charts keep investors out of the market when, in fact, this is the kind of chart you want to look at and say, listen, let me break this down and let me understand these numbers without just reacting to the sharp decline, right, Patrick?
It is. And I mean, certainly when you come from a peak to where it's come down, it looks very dramatic. The other thing we have to just shine a light on when you look at HPI is that it is very lagging. So we also have to keep that in mind. So let's go back to what we consider when we look at real estate is, we're looking at what is happening economically, what's happening with the region. We're talking lots about supply and demand. We're talking about the influencers called, for example, politics and interest rates. We can't step over the fundamentals around the health of an economy, the population growth. So when we see this, it is, to your point, dramatic. It drives emotion, and that emotion will often make people make bad decisions, like sitting on the sidelines at a time where this, in terms of growing net worth and growing a portfolio, this is where opportunities exist, and you have to look at the numbers for what they are.
And if you consider those economics, Patrick, you just talked about, just without getting, because I know we're going to talk about our rapid fire economics. I have a sticky note right here on my desk to discuss it, but I do want to talk about just the supply and demand alone. If you look, we are currently at a 20-year low for supply, 20-year low in terms of properties coming onto the market. And on the flip side of that, you have I forget how many year high, maybe a 20-year high, maybe an all-time high in terms of immigration and people coming into the country. So you have this massive strain on the housing market where you have huge demand and very low supply. Where do you think prices go when you have a high demand and low supply? You don't have to be an economic superpower to figure that out. It means prices will eventually go higher. Whether it happens this month or next month, I can't tell you. And quite frankly, I don't care. What I could tell you is it's going in the right direction.
But yeah, and let's not just even, we have to expand off of supply and demand. It's not just supply and demand. It's the economic health. And although Canada seems to be, and they look into the future, they're talking about soft landing. And, at this point, nobody's seeing a technical recession. Now, I want to just one light I want to shine on something called recession. What is a recession? We talk about technical recessions and negative GDP growth. Nobody's seeing that into the future. I still am not even looking at the leading indicators seeing that. I'm not seeing it yet. Am I seeing softening? 100%. JG, we talked about at the RAIN meeting where we talked about business and where businesses are going, and they're nervous because of lending and because of a potential slowdown. But having said that, none of it is bad news. So we're not looking at just supply and demand. We're also looking at the economic health of the country overall, and it looks pretty positive. So when we consider that interest rates, man, we can talk about it shortly. But Tiff, I don't see Tiff going any higher. Maybe he'll hold, but I don't see him going any higher. So we even see the influencers changing. So when we look at the economic health of Canada overall, specific regions, we look at housing, and as much as it's talked about, and there's a lot of conversations about affordability, and it's not fair, and they're never going to get this cut. Like there's a lot of that noise. Just get back to what it is. And this is an opportunity. Again, we talk about it from a real estate investor's point of view. This is an opportunity to employ strategies that work in this market.
Property prices covered. Not bad. I got good aim today. Okay, let's move into our second topic, Patrick. And we're going to talk about inflation numbers. But you just said the words, and I just heard them. You said the words Tiff Macklem, the Bank of Canada, the governor of the Bank of Canada. And I think I'm going to start calling him the genius. Tiff the genius. Tiff the genius. How do I want to just get your reaction to Tiff the genius, who clearly got inflation under control, Patrick, because inflation numbers are ticking down again. The report just came out, and we're going to dig into inflation quite a bit here in this episode. But inflation came down again. I think it went from 5.2% to, I forget the exact number now. It's under
4.8.
It's low 4.4.
Why are you mad?
4.8.
No, 4.4. I have it right here. 4.4 in March.
Okay.
Down from 5.2 in February. Tiff the genius at it again, Patrick.
Well, he's got one fan. You just do that to piss me off, and you're doing a good job. So let's be really clear about it. I don't think for one moment that interest rates had a really profound effect on inflation. I didn't think from the start. I guess what it did was, it would slow down housing for a heartbeat. But at the end of the day, there is one fundamental that we have to keep coming back to in the world of inflation. Number one, supply chains opened up, and all of a sudden supply was back on the market. That helped to bring costs down. We also saw energy costs drop. I keep going back to that, and I talk about it on and on and on. And I just can't stop beating that drum, because when we look at energy costs,
you kind of do sound like a broken record, just so you know.
I know. But I don't know where to go with it. People want to make it more complicated than that, and I don't think it is. And I realize that there's all sorts of nuances involved with it, and I get all that. But when you look at even the wage pressure, there isn't a ton of astronomical wage pressure happening in the country, other than from our now public service workers. Don't even get me going on that. But let's put it this way. When we look at inflation coming down, we saw fuel prices or energy prices coming down. That's what drove most of the decrease. Had nothing to do, in my world, with interest rates. Although, when we look at inflation, here's what does start to happen is demand at certain levels, certain demographics starts to come off, because, of course, they don't have the disposable income. That seems to slow things down. But food prices, they're talking about food prices being down. I don't know if you want to show that particular graph, JG, but just give me a minute to just talk about that CPI basket of goods. The government is notorious notorious for changing that basket of goods. Oh, beef prices came down. Well, okay, 3 months ago you were comparing beef prices of porterhouse or ribeye, and now you've got hamburger in there, but it's all beef. And I'm not saying they did it in this particular case, but that basket of goods is always changing, always shifting. And unless you're following it closely, you're not seeing those changes. I don't follow it that close, but I just know that those changes are often happening and we're not aware of it as the consumer.
Well, I'll let me expand on that, Patrick, because I do think it's very important, which is the graph you're talking about here. I'll put it up on the screen, which is awesome. And that is, this is the contribution to changes in Canada's inflation rate. What this means is this is how inflation is coming down. Energy has had the biggest impact, 5.2 per just over 5.2% of the inflation is energy. And because it's come down so dramatically, as you've talked about, Patrick, that's had a big impact on inflation. Owned accommodations has also come down. Food and groceries has also come down. Upholstered furniture also come down. Wooden furniture also come down, and everything else has also come down a little bit. And those are the percentages of that they make up of the CPI, which is a basket of goods. So and it's a great chart because you're absolutely right, Patrick. And Tiff the genius, and we'll get back to Tiff the genius here in just a second. But it is a good chart. You are absolutely right. Energy has had a big play in it. Supply chains have had a massive play in it. But I will talk about this shifting basket of goods. The fact is that the average investor needs to understand that there are a ton, and I don't know the exact number, but there are many, 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 and I'm talking about probably a dozen or more baskets of goods that they measure in terms of CPI. And sometimes they exclude mortgages, and sometimes they exclude energy, and sometimes they exclude food and variety of things. They measure a ton of this stuff. It's not the Statistics Canada, Patrick, changes from my perspective. It's not that they change what's in the baskets. It's that the media chooses the basket that they want to fit their narrative they're trying to push. And that's what the average investor is reading. The average investor is not going to Statistics Canada and reading the actual definition and actually reading what's in the baskets. It's the media that manipulates the narrative based on what they want to say. That's the problem, in my opinion.
Yeah, and the point of it all is that it's a very hard number to kind of put your finger on and dial it in so that you really understand it. It is a moving target. They reclassify goods. To your point, what is the media choosing to shine a light on? At the end of the day, we all are going to buy food. We're all buying fuel. As much as fuel prices have come down, listen, I paid $1.98 here in BC for a liter of regular fuel, by the way, not premium. And so when you come to certain provinces and you look at it and go, we joke about BC is bring cash. I can tell you, for example, I'll give you a real live, is that my vehicle insurance cost here is 40% more than in Alberta. Make sense of any of that. So we look at CPI, we look at inflation, and the reality of it is we're going into a store, we're paying more for a coffee, more for insurance, more for gas. So whatever they're selling us here, whatever deal they're pitching, to me, the reality of it is you feel it when you're going into the store. And of course, what we could talk about is, how about taxflation? We don't shine a light enough on taxflation and the fact that our carbon tax came into effect on April 1st and everything went up and we are being taxed to the max. So that's the term I'm using, taxflation, and I think we need to include that as well. So there.
You heard it here first, folks. Taxflation, that's a new thing. I mean, this is going to take over. But Patrick, back to CPI for a second. There are, like Scotiabank, for example, is predicting that we're going to be sub 3% inflation by the end of this year. And you have very appropriately said, so does the Bank of Canada. They also clearly are thinking this. That's why they've held rates for the last couple meetings. And we expect this to continue. And we'll see where it goes.
We'll see where it goes. Let's, for those of you who are listening, going, where are interest rates going? Right now, the way, bond yields, we don't see rates. I don't see rates going up. That's for sure. Will they come down? It's anybody's guess, but I just don't see them going up at this point. There's nothing indicating they will. Many are actually, it's already built into the bond market that they're going to come down. So we'll see.
Inflation covered. All right, next, Patrick, we're going to talk about unemployment and employment. Now, I want to just start out and put up a graph about employment, because the last couple months, and I don't have this off the top of my head, so if you do, please tell us. But the last couple months, the predictions, everyone has been so way off on employment. They were predicting 10,000 new jobs, and it was like 130,000. Then they were predicting like 4,000, and it was 35,000, or whatever the numbers was. Here are the numbers here. Like for example, in January, it was 121,000 new jobs, and they weren't even predicting like a tenth of that. And then it was almost 30, yeah, over 31,000 new jobs in February. And then in March, now we've had just under 19,000 new jobs. I don't know what the prediction was, Patrick, but I'm curious to see if they were closer than they have been in the last two rounds.
My memory serves me; they were off by 3x. So they were anticipating 6,000, kind of 7,000, 7,500, and we ended up at just shy of 20,000.
Very good. So unemployment, Patrick, still continues to kind of hold steady, but it's at an all-time low. But it's steady. It's not gyrating up or down, which is good for us real estate
Well,
investors. It's good.
unemployment.
I just, before you get into it, Patrick, I just want to talk about the fact, why is it good for us real estate investors? This is important. It's good because as a real estate investor, you depend on tenants to pay their rent. And when unemployment is low, that means those tenants have jobs. And when those tenants have jobs, they pay their rent, and you can continue to, your real estate investment business. And too many times, Patrick, as real estate investors, they're only thinking about their job. They're not thinking about their tenants and all of those jobs. They're only thinking about their job, whatever they do, whether they're, doctors or consultants or whatever job they have. You got to think about the tenants, not just yourself. So I just want to say that.
That's a perfect point. And I think that we have to consider. So when we talk about these things, it sounds like, well, what does it even mean to me? What we're doing is looking at the economic health of what's going on, and then anticipating and looking into the future as much as we can. When we look at unemployment numbers, they're actually a lagging indicator. But the point is that we want to keep an eye on them to see that they're not increasing. We actually want to anticipate, are they going to increase? And there's nothing right now that says they're going to increase. We're not hearing, like in the US, we're hearing a lot about Amazon laying off and whatever other tech companies are laying off. I think Twitter and Zoom, and we've heard all these big layoffs, 20,000 of this, and Walmart shutting down stores. It's really sounding quite catastrophic. And that's just the news headlines. We're not seeing that in Canada. My point is that our large corporations, I can talk, are not making big layoff announcements. It's quite contrary. They're saying we're still having trouble getting the people that we need, the skilled labor that we need. I think there's some things we got to pay attention to, which is in the world of construction. We know that contractors and builders on the big condo units are touching the brake. Costs are going up. Labor costs, they're worried about. The point is they're slowing things down. So if we see some construction industry stuff kind of starting to show up and saying, okay, there's more layoffs happening there, or it's softer, that might be an indicator to kind of watch. But any of our leading indicators are not showing any signs that should concern us. So as investors, we know that we've got a working population, we've got population growth, and they're making money, and that's what we want to know. And that's what's happening right now.
One thing to note, though, is job vacancies are coming down, and I think it's because job vacancies are being pulled off the market, is what's happening. They're being filled and they're being pulled off the market. There's no doubt. I personally know many business owners who, as they lose staff, instead of replacing that staff, or they were thinking about hiring some staff, say last year, and now they're thinking, you know what, I'm just going to pause a little bit, and they take the job vacancies off the market. So job vacancies are coming down. I don't think because they're necessarily being filled. I think it's mostly because business owners are taking them off.
That's exactly what's happening. And I think that if there's something we want to shine a light on, it's this. I think it's another nuance that we can't ignore. And that is that boomers are retiring. So as much as we think about unemployment going up, what's happening is their boomer population, that really skilled, knowledgeable tradespeople and just in general work experience people are leaving that place. And if anything, and JG, you're in the industry, you know that trades are more difficult, and young people are not kind of moving into the trades as, let's say, that boomer cohort did when they were young. It's not that way anymore. So if there's a risk to an economy, and I mean, this is on a North America scale, for sure, is that we're losing a lot of that skilled wisdom, if you will, and talent in the labor market of skilled labor called tradespeople.
Well, 100%. I think actually we have another graph, Patrick. This one really fires you up, and rightfully so, which is we talk about the increase in new employment from February 2020 to July 2022. I mean, almost 87% of new jobs is created by the public sector, only 56,000 by the private sector. That's a pretty significant swing. I'd like to see the stats, frankly, though, Patrick. I'd like to pull this graph and see the stats in kind of 2-year chunks or in 5-year chunks, from 2015 to 2020 and then 2010 to 2015, and kind of, try to compare this because we have no comparative and it's hard when you don't have a comparative. So, but nonetheless, it's an interesting number.
Well, it's a number that we should all be paying attention to and be concerned about. Now, you've got a lot of people going,
yeah, well, they've hired him because there's been so many people retired out of the government.
Okay, got it. But no, our government bureaucracy is actually ballooning. And here's the concern about it. As I've said many times, if these are not productive in terms of what they are, they're bureaucratic, they're administration. If I ran a business and all I had was administrators and I didn't have salespeople or manufacturing people, that's what our government is doing. That's what gets me fired up about it. Because here's the other side of it. The bureaucracy is what cogs the wheels of productivity. It is why we run into the problems that we run into. And this is not this is one of the biggest complaints this country has around housing, is that trying to get property zoned, trying to get property zoning approval, trying to get building permits is caught in the cogs of the bureaucracy. So when we see this kind of growth in the public sector, I'm not saying none of it or a lot of it is unwarranted. My observation is that it is. That's just me. I'm a capitalist in that regard. So I look at productivity, and this is something that we're paying for. This goes back to the taxflation part of it. And I'm going to share this. I don't know if this is the right time to share it, but I will share this. And I did share it with you, JG, which is in Chicago. You got to hear this. In Chicago, 80% of their municipal taxes, and they're not even the top city, by the way. They're like 15 on the list. But this was the article that showed up. 80% of their municipal city taxes go to pay their public sector pensions. Why? Because the public sector pensions are being squandered and are losing value, and people want their money because they're exiting. So this is where these things can go, and this is a future concern that I think we have to look at as a country overall. What does it mean to us as real estate investors? Nothing, but as people, well, I shouldn't say nothing, but as people, it means more taxflation.
One thing you said there, Patrick, that's fascinating is how we have this massive cohort called the baby boomers that are retiring. We know COVID accelerated those trends. And by the way, just so everybody knows, that's one of the reasons the unemployment rate is so low. Look at the unemployment rate in the US, Patrick, 3.5%. I mean, that is crazy. It's crazy. It's stupid low in Canada. That is nuts in the US. And a big part of what's driving that is how they measure unemployment. When people are not out there looking for work, that all factors in. If you're not out there looking for work, you're not even counted in the unemployment rate, right? Which is fascinating. So people have to dig into how unemployment is actually calculated. That's a topic for another day. The point is you're absolutely right. Massive cohort exiting, which is impacting unemployment rate for sure. And I expect a low unemployment rate for a very, very long time.
Until the robots come and the artificial intelligence.
That's for another show, Patrick. That's for another show.
The AI will replace you and I for sure. It already has.
Oh my God. I hope it does. I'm tired of working this hard. I want AI to take over, put my feet up a little bit,
And nobody appreciates us. Comment. Let us know that we're delivering some goods here.
Comment, like, subscribe. Those are the 3 ways, right, Patrick? Those are the 3 ways to our heart. Comment, like, subscribe. Next, in case people think like, does he really have sticky notes? Look, he really does. Commercial property is the next sticky note, Patrick. Since the beginning of COVID, we've known that there's going to be a fallout in the commercial property market. We've known this. The can is getting kicked down the road. We'll talk about why and how. But this commercial real estate and commercial property, these leases are 5, 10, 15, 20 years long. So this can get kicked quite a ways down the line. But there's some interesting stats that are showing how these downtown property markets are really suffering. I mean, San Francisco, Los Angeles, even Toronto is struggling, Vancouver. I mean, they are not what they once were. And there's a lot of people saying, listen, it'll never return. And in fact, we're going to have to retool these properties, which you and I have talked about on this show many times. But there's going to be some pain in the commercial property market, no doubt about it.
Well, this is, I think, is going to be an epic fallout. And I haven't even told you this, but I'm going to on the Everyday Millionaire podcast. But I'm thinking I'm going to bring him on to the Rain channel as well. I'm having a interview with a true goat in the mortgage lending industry, greatest of all time, and that's Ron Butler. And I've scheduled a interview with him. Now, Ron Butler been around 40 years in the housing industry, but he also looks at what's going on in the mortgage industry. He knows intimately what's happening in the commercial space, and just some stuff I've been working back and forth with him. But we talk about what we see into the future of that commercial space, JG. And at the end of the day, what's happening is people are not going back to the office like they were. We've said that many, many times. But what's unfolding is leases are not being renewed, or they're not being renewed in their entirety, what they once were, because many are scaling down. Then on top of it, now you're going to go to debt finance, and the banks are now pushing pause, and they're not necessarily stepping up and writing checks. They do not want to take the risk. And then to add to that even more, when we talk about even the public service sector pension plans that are out there, a lot of investment is happening in that mortgage industry, or that commercial mortgage and space. And so we have to look at what we see in the future. And you're going, I think there's a lot of pain coming over the next few years in that commercial space. And we're going to hear a lot about it, and we're going to see the results. And then finally, one other part of that I don't want to step over, which is I think we're going to see those smaller downtown businesses continue to struggle. They already are. Many are closing the door, but they're small business, so you don't hear about them. But if you're driving in those downtown cores, we're seeing it. You're seeing where things are boarded up, or for lease signs are up. And those smaller centers, whether it be clothiers or sandwich shops or dry cleaners, doesn't matter, where they depend on that downtown walking traffic, are feeling the pinch as well, because they're not having the sales that they once had, yet they're paying a premium for that space. And they're not going to renew their mortgages because they can't afford to.
That space is incredibly expensive. I mean, it was really a premium market at one time. And the leases that were signed, I mean, I just have, I mean, my heart goes out to people who signed leases in like early 2020, 5-year leases, that are stuck in these leases and at those really high rates. Now, many of them have renegotiated because the market landscape has changed. The point though, I think you're making, Patrick, is absolutely correct. There's some pain to come. I want to paint this, I'm going to do what JG does. I'm going to paint this with a little positivity. Okay. So it is possible with my rose-colored glasses. It is possible. Now, I don't have statistics to back this up, but my hunch tells me that it is possible that there's a couple things that are going to happen as this pain comes through. First of all, some of this property is going to be recalibrated into different types, right? You're going to have, for example, retail, which has really gone down. You're going to have it flip into, for example, Amazon needs downtown space. They want to get their goods closer to downtown so they can distribute to the condo market and so on and so forth. So some of this space, some of this property, retail space, is going to get reconfigured to, for example, some industrial or some other type of commercial space. Also, a lot of it's going to get rezoned into residential, and they're going to build condos out of it. There's no doubt about that. I think some of it, and I'm not saying all. The other thing that I would say, Patrick, is because this can get kicked down the line, sometimes, as time goes on, sometimes what happens is it gives you more time to retool. And I think this is a really long play. This is a 5, 10, 15, 20-year play that's going to take some time for the rooster to come home to roost. And as a result, they got time to figure things out. That's my positivity on the market.
Yeah, I like to be positive too around it, the repurposing of some of these units, but it's going to take time. There has to be some changes and some shifts. A lot of these kind of hard times drive innovation and creativity. To your point, it's going to be years down the road, but in between all of that, there's going to be some real discomfort. The challenges, if I've done some research on the repurposing of product, like commercial space, whether that be office towers, even when the conversation is around taking some of these big monster malls that are feeling the pain, primarily in the US, but I don't know about Canada so much. I see it and hear about it more in the US, and that is turning those into. But here's the thing about it. Plumbing isn't right, zoning isn't right, safety isn't right. So of course, then we run into the zoning and the bureaucracy, that the hoops that have to be jumped through in order for that to happen. So as much as I see it, it's going to be very, very slow in terms of that transition. And I think that's where, in between all that, we're going to feel and see lots of pain and some shutdowns for sure.
What I will say though, Patrick, is as a real estate investor, and I think that, the people who watch this show appreciate when we kind of, drill it down to what they can do or what they can look out for. But I think you're going to see some deals. I think there's a lot of like these kind of small retail plazas that are coming up for sale, and some of them are really struggling. And I think that for the right investor, maybe those deals are very good. I know myself, I'm not into that particular market, and I'm being very careful about considering those kinds of deals, because I think that these people that own the bigger buildings, they have no choice. They're gonna discount that space, man, and they have deeper pockets than I do. And I'm not playing that game. I never want to play a game where I'm racing a bigger player to zero, because they're always going to beat me there, because they have deeper pockets than I do. So I caution real estate investors that look at these space and think, oh, wow, that's a really great deal. Yeah, but don't forget, you're buying real estate for the future, not for the past. Don't consider where that building was. Consider where it's going and where you're taking it. And this is where I think real estate investors have to be careful around this type of real estate asset.
That's such an important reminder. Where do you see it going? And what's your thesis for it going there? Like, how are you seeing it? Why are you seeing it that way? And what are you basing that on? So, such a great reminder.
Did you just call me a genius there a little bit, Patrick? I felt like it was kind of almost rolled off your tongue.
J Genius, it's right there.
See? So it's not Tiff the genius, it's J Genius. Is that what you're saying?
J Genius right there.
I have the mind of a mastermind. What's that? I don't know, but I'm so creative like that.
All right, Patrick, for our final segment here, we're going to talk about rapid fire economics. And we kind of put all these economic indicators that are coming out, we decided to put them in a rapid fire economics because there's a lot to talk about. So I think first and foremost, I'm going to start with the weirdest one of them all, which is concrete prices, Patrick. Concrete prices are kind of going through the roof, which is fascinating.
Well, it is really interesting to see that concrete prices are going up. But I think this speaks to why some developers and builders are starting to slow things down. They're tapping the brake. Rising costs, including the financing side of things, and labor shortages, and the chances and the possibility of having to see those increases on the wage side of things. And I think this is all playing to that part of, particular slowdown and the rising costs. I mean, I don't know what you're going to do about it, because you got concrete, we're still building stuff. And as long as we're building it, those costs are not going to be absorbed by the developer. So,
and that's a big reason why people are flocking to Alberta, is that affordability. Mr. Alberta, it wouldn't be a show if you didn't take a minute to plug Alberta again, but it is one of the most affordable places to be in Canada right now.
Well, yeah, and that's not going to go away. And it's, we keep talking about this, and I get all the cycles. Listen, I've had so many conversations with those individuals. JG, you and I just talked to somebody from Alberta who was down in Toronto. They saw, and they had the same conversation, is that from a Toronto perspective, yeah, Alberta, they just go through this cycle, and they're, everybody makes money, and then they lose money, and then they make money, and they lose money. Got it. And so those are the same individuals that aren't necessarily paying attention to what's happening today at a national level. It's changed the landscape. So what about Alberta? You still got the lowest cost of living. You got the highest wages. You've got the lowest housing, even including rents, by the way. And, we're not paying HST. You've got, depending if you're into Calgary, you've got proximity to the mountains. You've got great lifestyle. And back to a quick comment, I got sidetracked in it, but I want to talk about recession. And, one of the things about a recession, although we don't go into a technical, a recession is that for those individuals who are feeling that pinch, who are feeling the pain, who have had to adjust lifestyle due to the fact that they can't afford to do what they did before. I mean, there's some huge stats around, how many people are not eating as well or as much as they once did because they can't afford it. There is a lot of individuals in Canada that are going through that discomfort, where for example, in Toronto, people are having to pair up because as singles they can't afford a unit and the landlord's not considering them because they're singles. It's all singles. There's all sorts of stories around it. Where you get to Alberta and it's, guess what? It is affordable. The pace is good. Jobs are great. The economy is diversifying. Right now, oil, guess what? Oil right now is at a reasonable price. I think it's going to go up, but right now in Alberta, they're making money at the oil price it is today. So I definitely don't see oil prices going lower, at least not for any extended period of time. So Alberta's economy is healthy. Western Canada in general, Alberta, Saskatchewan, Manitoba, those economies are still pretty robust.
Mr. Alberta.
I know.
Let's talk about, Patrick, housing completions. We got this kind of cool graph. Maybe you want to take us through it in terms of housing completions. Fraser Institute put this out. Definitely, you can see kind of a continuous push towards apartments and other unit types. Now, condos fit into that, right, Patrick? Condo towers, because I think a lot of people consider, first of all, there's two factors that are going on that's very fascinating. Number one is multifamily development has come back recently, which for many, many years it had went away. It's coming back, meaning developing properties that have more than 5 units, but developing 10 unit, 20 unit, 30 unit, 40 unit properties. For many, that was pretty popular in the 70s and 80s, Patrick. It then went away and it's coming back now. So that you're seeing the green bar get bigger because of that. And also condo towers fit into this category as well, which again makes that green bar bigger.
Yeah. And our friend Derek Lobo, who we've had on our stage and I've had on my podcast probably 3 or 4 times, plays big in that space. He's one of the biggest players in the purpose-built apartments. And that is, in fact, a growing industry. And we are seeing an uptick again in that space of development. The point of this particular chart is if you go back into the 70s and 80s and you look at all of the housing that was being built through that time, even when interest rates were significantly higher, the point is that this goes back to what we talk about in terms of bureaucracy and public service. Why is it that back in the 70s and 80s, they could build the volume of single family detached that they were building back then? And at the end of the day, it was really the shift from then to what it is today in terms of zoning and NIMBYism and all of the things that are getting in the way of development. That's why, the government talking about how they're going to handle this housing crisis, they're not going to get it handled. I mean, when you're the problem yourself, you're not going to fix the problem. How do you look at yourself and look in the mirror and go, oh, I'm the problem? The government's not going to do that. So we don't have any real optimistic view of how all of a sudden building is going to start to happen. Now, I know both Ontario and BC have done some cool stuff in terms of what they're saying from single family and rezoning and making it easier to put a small multi on there, like triplex, duplex, fourplex, that kind of stuff. That's good step in the right direction, but it's not going to fix the problem.
It's a huge step in the right direction, though, Patrick, and definitely was a necessary step and a very, very good step. So I agree, may not fix the entire problem, but definitely frees up us real estate investors to make a meaningful contribution. Because don't forget, and I know you know this, I'm saying don't forget to the audience, which is that, like, I forget the exact number, but it's like 75 or 80% of real estate accommodations is provided by mom and pop investors like you and I. It's not the bigger companies that are providing most of the accommodations. It's people like us that are making the difference.
Well, I think you make a really good point, and I should differentiate. So when we talk about the housing crisis right now is really about those individuals who want to buy a home and they're priced out of the market, they can't afford a home. This is the homeowner conversation. To your point, the changes that governments put in place are huge changes from a rental housing provider perspective, and for individuals who need to rent accommodations because they can't get into the housing market. That, in fact, will make a big difference on that particular segment or that particular segment of the sector of the housing market. So that's a good differentiation. Good job, JG. J Genius. More J Genius. It's nonstop.
More J Genius. We talk about geniuses today. We talk about Tiff the genius. Talk about J Genius. It's some. I used to say, some PF magic is how I would refer to your genius, Patrick. But
I haven't been feeling very magical these days. But anyways, carry on.
Hey, listen, we're done with the show, by the way. But I have a question for you. because you were around back then and I wasn't, which is this. Talking about Tiff the genius, right? And I'm making a joke about this Tiff the genius thing, but you know what I find fascinating, and I wasn't around back in the day when they were hiking interest rates from 5 to 8 and 8 to 10 and 10 to 20%, right? But you were, or I was too young, I should say, to remember. I don't remember. But one thing I noticed in the last like year is how Volcker, who was the guy responsible for making those moves, Patrick, how he has been touted as a genius, and it was such a genius move. Now, because I wasn't around back then and I don't remember, the question I have for you is, did people look at it that way back then in the early 80s, mid 80s, when rates were going from 5 to 8, 8 to 10, 10 to 20%? Was he touted as a genius back then? Or did people think he lost his absolute rocker and it's only 25, 30 years in retrospect that people say, wow, that was the right move to make at the time? That's my question.
Well, I think, Volcker is US, but when we had our rates go that high, the pain, many people lost their homes. It was really catastrophic, economically. And, I can't speak as much to Ontario back then. Of course, I was like you. I mean, I was young. I was 18, 20 years old, whatever it was. And it really wasn't resonating with me in terms of what does this all mean? I just know that I was working. It was the only job I ever had at that time in the oil industry. And my supervisors, those who I looked up to, the adults, if you will, we're talking on a regular basis of how they're going to cover their mortgage payments. And some of them were fighting to keep their homes and doing all the rest. So there's a lot of pain that goes on in there. And so as much as it was a great move, perhaps they crushed the economy. A different time. I think we've got to be cautious about comparing because it just was a different time. We look at these conversations all the time that, some boomers go, yeah, it was like 18%. Well, that's true. But you were paying 3 times your income for a house. Now it's 7, 8, 10 times income for that, to have a home. So there's an imbalance and there's not really a fair comparison of then to then, I guess is my kind of view of it.
That's fair. I mean, the point of it is not that I'm trying to compare what just happened or what's happening to the 80s. That's not my intention. My intention is to show how, in retrospect, people call him a hero now or a genius for making those tough decisions back then. But this is 30 years later, and that's why I call Tiff the genius, because I'm just saying that in the future he will be touted as a genius for the moves he's made.
No, listen. I'm going to make sure that
Just telling you, bud. Just telling you. I'm not saying I think he's a genius. I'm just telling you that he will be touted as a genius. You wait and watch. They will write books about him.
No, they won't. And it's not. Are you kidding me right now? They'll write books about him. They'll throw books at him, but they won't. Oh my gosh, write books.
I got a live one.
Oh my gosh, they'll write a book about him.
All right, folks, that's it for today's episode. Hopefully you've enjoyed this show, and we would really love, please, like, subscribe, comment. We want to hear from you, and we'll see you on the next episode of Rein It In.